To Webinar Wednesday. This particular Wednesday, we have an absolute special treat for you. We have former ASIC Commissioner and non-executive director of Income Asset Management Group, Danielle Press. Danielle has extensive experience in capital markets, asset management, and financial services regulation. She was a commissioner of the ASIC from 2018 to 2023. She currently chairs the Superannuation Trustee Boards of Insignia Financial, and her leadership experience includes holding the CEO role of the Myer Family Corporation and Equipsuper. Prior to that, Danielle spent 17 years at UBS in a range of roles, focusing on investment, risk management, client solutions in Australia, Singapore, and Chicago. She began her career in the Reserve Bank of Australia in the International Department. Danielle holds a Bachelor of Economics with honours from the University of Western Australia. Danielle will be having a beautiful conversation with our compliance manager, Ryan. Would you like to take it away?
Sure thing. Thank you, Jonathan. Danielle, thank you so much for joining us.
Pleasure.
I'm very excited and a little bit nervous about having you here today, so hopefully it all goes smoothly. If you're ready, we can jump straight in.
Sure. What can go wrong?
No, what can go wrong? So as Jonathan mentioned, you've got a lot of experience in the industry, over 30 years, working as an ex-regulator as well. What are some of your reflections or thoughts on the industry over that period?
Yeah, sure. It's a great place to start. I would like to add I started my career when I was 12. I refuse to believe I've been working that long and for that many years. But let me start by stating that the absolute obvious, like the financial system, advice system in Australia has experienced a huge amount of change and transformation over the last sort of 3 or 4 decades. And there's been a real shift in advisor demographics, regulatory reform, and really importantly, evolving client needs. And I think the client expectation and that what our clients expect of us has definitely shifted over time. And no doubt the way we are delivering advice is changing as well. But in a sense, it's almost back to the future a little bit, right? I mean, I feel like we're going back to where we were, say, 30 years ago.
What do you mean by that? Can you elaborate a little bit more?
Yeah, so when I started as a baby banker at UBS, there were lots and lots of different options for how clients could get advice. So there was definitely, the big banks, AMP, AXA, and most of the people on the screen of the right age would have come from AMP or AXA at some point. Colonial have all... they were there and they were offering that mass scale advice, but there was also a lot of smaller players, independent financial planners. And in fact, there were more independent financial planners than they were big guys, right? And so what we saw was, that real choice in the planning option for clients. Then what happened was all the banks gobbled up the little planning officers and the advice licensees, and we sort of moved to more of a product sale position rather than what I think of as true financial advice, and actually in my mind what our clients really need, which is that broader holistic advice around lifestyle, around estate planning, and around obviously investments there too. I think that consolidation meant we lost our way a little bit and clients weren't in the middle of the conversation anymore on average. And look, that doesn't apply to everybody. And I'm sure that there are people on this call who would almost be offended by that statement. But I think as an industry as a whole, I think we lost our way. And what that finished up seeing was the Hayne Royal Commission. And clearly we saw misconduct that was ultimately there. It wasn't hard to create great headlines, because some of the stuff that was going on was pretty average. The outcome of the Royal Commission to me was completely predictable. Banks decided that there was way too much risk in financial advice. You couldn't make money out of the way they were offering it. And so they sold off their advice businesses. We saw this fragmentation back in the market again, and we're seeing the smaller players coming through. And in fact, there are no massive licensees left anymore. The response from the regulator was also pretty predictable. Like, it was publicly humbled, and the pendulum swang from being quite accommodative to being very unaccommodative and being very much towards the protection of consumers in all ways. Personally, I think that pendulum probably swung too far, and we saw too much blaming of the licensee, blaming of the advisor, rather than actually clients just making dumb mistakes. And, probably don't want to be quoted on this, but there is only one cure for stupid, and it's not legal. And we probably shouldn't all go out and do it. So I think that was one change. The other big change I think we saw from Royal Commission was obviously industry super becoming bigger and bigger. And when I first started in the industry, the reason I went to Equipsuper in 2010 was that I felt if industry funds and not-for-profit funds didn't stand up and compete differently, then the wealth of this country would have been in the hands of the big four banks and AMP. That is now completely turned on its head, right? And again, that's the outworkings of the Royal Commission. But I think what we're seeing with the industry funds coming through is they are very much like the tied agencies, right? They're about like the old insurance companies. And my fear is that unless policymakers and regulators are not very, very careful, then the obvious concerns that came out of Royal Commission will actually come out of the industry funds, particularly when they start selling products that are lifetime income and lock clients to them. So I think we're at a turning point here. It does feel like Back to the Future, and my goodness, I hope we've learnt our lessons, and that policymakers and government have learnt their lessons from the Royal Commission, and that we don't see those issues starting to resurface themselves just in a different form.
Being an ex-AMP employee for over 15 years, I can completely relate and understand exactly what you just said then. So,
well, that's good that I'm not just talking out of my butt.
Yeah, that's right. That's right. Look, ASIC continues to be very active in the financial advice space. Last year, they issued report 779 around choice super options, why people stay in choice super options. Some of those underperform or underperforming. In terms of accountability for that, do you think ASIC looking to hold advisors accountable, or is that a shift more towards the platforms or the super trustees?
Yeah. I think in the first instance, this report's actually a shot at the super trustees and the platforms. I think they are looking to say, regardless of whether the members advised or not advised, those products that are sitting on the platforms need to be good. And they need to be looked at and make sure that they're not underperforming, and that they're reaching the same standards, if you like, as they would if they were in a pooled vehicle or a master trust of some kind. So I actually think the outcome of that report will be more around the obligations of the licensees, of the platform providers and the platform owners. That will change, I think, the landscape. Like it's quite different when you think about the product that would go on, say, a wrap platform as a superannuation fund than it is if it's just ordinary money that is advised, that you have less of a regulatory oversight on. That said, I do think that advisors need to be very careful about only looking at, is it on my APL? And if it's on my APL and it's got an external advice, external research rating, it's fine, tick, I don't need to do anything more. I think they do need to show that they've been able to take into account the factors that matter for that client, particularly if it's underperforming. So, you might be saying, well, actually, the client's better off to stay here because of tax implications. That's fine. But you need to be able to show you've taken account of that, and you need to be able to show that there has been communication between the advisor and the client. I think particularly if something goes wrong. So if there's a fund that goes badly wrong that's on a platform and a wrap, my gut feel is that the regulator will go after the trustee and the platform. But if there is one licensee or one advisor that has a predominant exposure to that, then I think there'll be questions around, well, what did that advisor do and what did that licensee actually do to make sure their advisors were not putting not putting their clients into garbage products.
Yep, I totally agree. Okay, what about private credit? ASIC's making a lot of noise in that space. What are your thoughts on that? Where do you think that'll land?
Yeah, look, I think this one's really, really interesting. And Joe Longo's been very vocal about private credit and private assets more generally, actually. And I think that the noise around this is very much around transparency, and around making sure that clients, particularly retail clients, understand what they're investing in. And I think a lot of the noise has come out because they're sort of getting this rock star status, right, around some of the asset classes, the claims. We saw it in the GFC. We saw it before GFC, right, with the collateralized loans. I think there is a concern that that's going to happen again, and a concern that clients will find themselves in products that they don't understand, in products that are sold as if they are something else. And, we've seen Count now highlighting some of these concerns. We've seen some managers offering private credit as if they're an alternative to listed hybrid. And I don't know about you, but for me, they are not a listed hybrid. They are very, very different. I actually think the asset class has great value. And I like the fact that retail investors and wholesale individuals can get into these assets, because I do think they provide good return, and I do think that they can provide very stable income in the medium term for clients, particularly moving into retirement. But I think the issues here are around what is the transparency, what is the liquidity in the investment vehicle, and that if it's a commingled fund with long-dated assets, that cash flow is not being driven by new cash coming into the product, as opposed to return being thrown by the asset, because that just looks and feels like a Ponzi scheme.
Yep. And what do you think that means for advisors then?
Yeah, so I think what it means for advisors is that they need to be clear about what they're recommending to clients. Like, they need to be really clear around the transparency risk and around the liquidity risk. I think, we've seen, again, we saw listed hybrids sold as term deposits. They're not. I would hate to see private credit being sold as a hybrid where it doesn't have that secondary market liquidity and demand. So I think there's a clarity and an understanding that just needs to come through. Again, if an advisor is doing the right thing by their client and explaining in detail what they're owning, then we should be okay. And they should be okay. And I think there are some, there's some developments coming through the market. So certainly the group that Income Asset Management that I'm with are thinking about MDA type solutions here, where the client actually owns the underlying name as opposed to a pooled vehicle. That certainly ensures transparency. It doesn't help liquidity, but it certainly helps the clients in transparency. So I think the advisors need to be thinking about what the various different options in the market are here, because I do think these assets have great value for clients, but the way they're packaged and delivered matters.
Yeah. You mentioned Income Asset Management just then, and you are a director at Income Asset Management. With your long history in the market, also chair of a very large super fund as well.
Yep.
If we think about income assets for a second,
yes,
where do they fit into the conversation, do you think, with clients?
Yeah, so I think, income assets have always played a role as a diversifier in broad portfolios, and portfolio theory will say that you should hold some equity, some bonds, some cash. I agree with that. I think the problem is that they should be non-correlated until they're correlated, right? And that's the challenge with some of the credit exposure. Where I think fixed income assets play a really important role is as we move into that decumulation phase, or as you've got clients trying to liquidity match their portfolio, right? It's much easier to do that with a bond. If I know with certainty as a client, if I know with certainty what my cash flow requirements are and what my needs are, I can perfectly I can perfectly create a portfolio that will deliver that through a bond or through a fixed income strategy, thinking about when my coupons are being paid, when my my capital needs to come back. So that immunisation of portfolios, I think, is a really important role that fixed income plays, particularly when we start getting into drawdown phase for clients, when they actually need to rely on their assets throwing income to live off.
You mentioned immunisation, and it makes me think of geopolitical events at the moment as well, for some particular reason. And in thinking of that, I'm thinking about global markets at the moment, and everything that's being driven by what's happening overseas. What's your take on this? Is a bit of a grenade here, but what's your take on global markets at the moment and where they're headed?
Yeah, wow, that is that is the question of the day, isn't it? And you know, the equity market worries me with the volatility. We've seen that equity markets were overpriced going into this craziness. This is a correction I think we were always going to have. How far it corrects, I don't know. But I am still a believer in a single source of light, which is the sun. And ultimately, if I believe that, then, you know, I believe in markets as well, and that the single source of markets means that ultimately risk will be rewarded in the medium to long term. So, you know, I think we're in for volatility. That's not, you know, that's nothing new. I think if I said, no, there'll be no volatility forever, people would think, what rock was I living under? But I do think markets will settle. I do think this will recover. I do think, you know, as an economist, the global trade policies that are coming out of the US, I think are really bad for the world. You know, you could argue beggar thy neighbour will work for the US, maybe, if you're the strongest trading partner, which I'm not sure they are. So I think there is real concern economically about what happens. The impact on Australia, the first order impact of Australia are probably not that great, to be frank, and you could argue are probably potentially good for us. But I think that just the global slowdown in growth will be negative for Australia overall, which sort of sees equity markets being volatile at best. What is happening in the bond market is very, very concerning for me. You know, and I think, again, it was obviously very concerning for President Trump last week when his long bond went through the roof and realised that the funding, therefore, of the massive debt that lives in the US is going to be very hard. So that long bond piece, I think, is really challenging, and the volatility in the markets are challenging. I think it will continue. I can't see spreads contracting in these environments. So I think we are going to see, you know, continued volatility, widening in spreads. That, you know, when we're sort of seeing yields back up, you know, to maybe that 5% range, that probably actually creates some opportunity here, because that feels like a rate where I'd be prepared to buy it. You know, when I was back at UBS, I lost an awful lot of money not buying a Japanese bond under 2%, right? Because I just couldn't see where the value was. And I think I would have lost, if I was managing portfolios, I would have lost a lot of money in the US not wanting to invest under the same sort of level. Once it backs up to 5, you sort of go, actually, there's probably some value in there, and it makes some more sense to start buying. So I think it will create opportunities. But again, there are going to be risks in that opportunity and risk to capital. So if you're thinking about an income, I think the income piece is actually nicely buffeted by this. If all you need to do is hold the bond until it matures and get the income clip. But I think there will be continued volatility. But, you know, volatility creates opportunity.
I agree. I think definitely some continued volatility for the next 4 years is probably on the cards.
I think so.
Okay, so back to maybe some more compliance-based questions.
Sure.
You discussed earlier where the industry sort of come from over maybe the last sort of 30 years. If we think about what's going on, I guess, right now, or in the short term going forward, we've got the delivering better financial outcomes reforms or packages going through. Some of it's already gone through, and some of it's looking to go through. Who knows what's going to happen with the election around the corner, but we'll see.
Yep.
I guess the question is, what's your take on how that sort of the balance between I think what it's trying to do is have efficiency and sustainability for the industry, but then have those sort of client protections in place as well. Like, is that balance? Like, how do you think that sort of works out?
Yeah. So obviously that second tranche of the better financial outcomes is being prorogued, so it disappears. New government, even if it's the Labor government, they're going to have to reintroduce that legislation. And whether it gets reintroduced in the same form is actually an open question. Stephen Jones is not restanding, so we will have a new minister in place regardless. I suspect Minister Jones was trying to ensure that his idea about what this legislation needed to be was at least agreed by Cabinet so that it's harder for them to change it. But they can change it effectively. And I think if the coalition gets in, it will be quite different what gets entered into. I think regardless of what happens here and regardless of what that legislation finally looks like, I'm not sure there's a clear legislative fix, right? I'm just not sure that the industry will come together in a way that will allow legislation to fix this problem. And part of the problem is that, the legislation itself is piecemeal at best, right? It's horrible. If you look at Chapter 7, it's horrible. But a hot mess, I think it's been called a number of times, possibly even by me. But I don't think there is an appetite in government to throw it out and start again, because that is really hard, but ultimately that's what needs to be done. There is in excess of 20 different definitions of retail client in Chapter 7, right? I mean, how on earth do we think advisors can get through that in a way that is reasonable and sensible and not creating red tape? But that's not going to be addressed in this piece of legislation, right? And so I think I would love to see some of the tick the box compliance wound back, because I don't think it's actually adding value. And I think we've layered upon layered upon layered into the legislation, and we do need to pull some of it back. I do think the better financial outcomes packages are trying to do some of that. But I do think, that we need to be, as an industry, worried about what the spirit of this legislation is. And not necessarily the individual details of it. And what I mean by that, I would argue today that an SOA is not actually the problem, right? That the SOA itself, I don't think is the problem. But the problem is it's become the piece of documentation that covers all sins. So you want to put everything in and it becomes 80 or 90 pages. I had somebody argue with me while I was a commissioner of ASIC that the pro forma SOA that ASIC provides was not compliant, right? And my answer to that was, well, firstly, I think it is, but secondly, so what? It's the thing that ASIC looks at to say, are we going to sue you or not, right? So even if it's not compliant, I'm not sure it matters. Having said that, there is such a negativity around statements of advice that I would be absolutely fine if there was a record of advice. And I think the regulator would as well, as long as there is a record of the advice and that we can actually go back, and that, when you look at a problem and that when the client has a problem, that you can go back and say, well, yes, the advisor did have all of these things covered. They did talk about that. The client should have understood that. And from my comments right at the beginning, this is actually just the client being dumb. And you can't blame the advisor for the client being dumb, right? But at the moment, if you don't have a record and if you can't show that you've done it, then, that the way the system is structured and works is every time. And I'm not sure that's wrong. It's frustrating, but I'm not sure it's wrong.
Yeah, I completely agree. I think the statement of advice that's, I think you said 80 or 90 pages, I think we see them there 180 or 90 pages sometimes.
Yeah.
And I know the ASIC one you're referring to, it's the 20 or sort of 25 page one that you can find online. I think we move to that world where that SOA is just so big and it's so complicated. It actually becomes harder for a normal person to understand, as
Yeah, well, I think it's actually more dangerous for the client. Correct. Actually, because they're then just confused. And, again, I wind back to when I first started in this industry, and there'll be, I'm sure, many on this call that would have experienced this. We used to just write a letter to the client and tell them what we were doing, right? And explain what we were doing, and it was perfectly fine. Like, the clients knew what they were doing, they knew what they were up for, they understood it because we explained it. And I kind of wish we could get back to that world where we're more pragmatic in the way we think about our clients.
Well, it's almost like when you go to see a doctor and they're the professional, you trust them, and they've got that expertise backing them up. So if someone questions them or raises a concern, they can explain why they've done it, and that's
Correct.
As long as that makes sense, I think it's
I agree.
Yeah,
I agree.
Okay, well, from another, I guess, sort of from an inside the regulator sort of perspective for us, what's the take on ethical behaviour and self-regulation, expectations from the regulator for licensees like Interprac or authorised representatives like our advisors, in terms of what's the expectation? Yeah, what do they want us to do to be, self-regulating, and what's their expectations around our ethical behaviour?
Yeah, so I don't think we'll ever be in a position where we're fully self-regulated. I think it will always be a co-regulation environment, and we're moving towards that, I think, probably more slowly than some would like. I think your first part of that question was the regulator expectations. I think they expect advisors to act as fiduciaries, as, the custodians of other people's money. And therefore, there's an expectation that there is the highest level of ethical behaviour. And I think that's what we should, and what most advisors do, hold themselves to, regardless of whether we're self-regulated or not. I think there is always going to be a piece at the margin, and that's and advisors at the margin, and that's the bit that I think is frustrating for great advisors, is that, they're pulled down and held back by poor advisors. I just feel that's like it's going to always be, and no matter where you are, that will be. ASIC relies really heavily on the licensees to provide oversight of their advisors. In the current environment, that will absolutely continue, and I think will likely to increase, actually. And I think if there's advisors out there thinking that a self-regulated market where you're individually licensed and individually able to do whatever you like will be cheaper, I don't think it will be on average for the system. It might be cheaper for an individual, but it's not going to be cheaper. Self-regulatory environments are actually really expensive, and all we need to do is look at the US to prove that.
So you think there'll continue to be positions, room for people like me as compliance managers and licensees going forward?
In the foreseeable future, I think that is probably right. And again, if I was starting the system from scratch, you might think about self-regulation and individually licensed, but we're not. And moving it from where we are to that sort of structure, I think is, it's very hard to unpick this and to break to break this up. I think we've got a system that is broadly working. It's about improving it around the edge. It's about improving the system, not about breaking it and changing it. I just can't see how that's going to actually help that much.
Jonathan, looks like you've got a question.
Yeah, we've just had a question from the crowd. Just in reference to the considerations you were highlighting with DBFO.
Yep.
How does that align with the new class of advisor that look to be salaried by the large institutions?
Yeah, so that legislation hasn't come in yet. So the new class of advisor, my understanding, is not there yet. Correct me if I'm wrong. But I think at the end of the day, this is not a question of, well, let me go back. I argued very strongly against having a new class of advisor that didn't have the same education and ethical standards applied to them. And I lost that battle with Michelle. And the reason I argued that, though, was that we are talking about super funds and salaried advisors cross-subsidised by the fund providing advice to people at the most difficult time in their lives, right? At the most complicated time, which is retirement, which we're all talking is very complicated and so much harder than accumulation. And when we think people that are less qualified can give that advice, that feels very odd to me, right? So I'll make that first statement. I think at the end of the day, the issue here is about not even so much who gives the advice. For me, it's who pays for the advice. And the problem that I think is being highlighted is that, you know, this will be able to be cross-subsidised by the super funds out of the super funds. For the bulk of those super funds clients, we just need simple advice. I'm not sure that's a problem, actually, and I'm not sure it's a problem for the advice industry. These are clients that most of you won't want. Let's be honest. They're not clients that have got big enough balances for you to want, but they still need help. I do think at the end of the day, the advice industry needs to continue to articulate the value that we provide and the value that we offer to clients so that people will be prepared to pay for it outside of getting some advice from a super fund over a call centre desk. So, you know, we're talking about here broadening out intra-fund advice, essentially, for want of a better term. I'm not sure that will be a problem for most advice businesses because most clients will want more than that and will need more than that, actually.
The second part of the question address or looks to address how we as the industry meet the massive demands of the ageing demographic and how do we prepare or avoid a Royal Commission 2.0 off the back of the industry super funds doing effectively what the banks were doing previously?
That is an awesomely good question. And I think what it requires is for us to be diligent and very focused and I think very alert to the problems that can happen. I think we need, but it can't be solved by industry. It needs to be the regulator and the legislator. It needs to be thinking about this as well. And I think they are. I hope they are. It is the thing that keeps me up at night, actually, around how do we make sure, as a chair of a big super fund that's not an industry fund, but how we make sure that we are providing the right advice to clients as they move into retirement and not locking them into products that they can't get out of, or that if we are locking them in, we're providing the great outcome, I think is really critical. I think there are some legislative changes that have meant locking clients in are actually more likely than not, right? And so I do think we need to make sure from a regulatory perspective that, you know, we are thinking about this, that the regulators are thinking about it, that we're watching this, that actually you know, we don't get to this position again. It scares me that we will, though, right? Because I'm not convinced that we've learnt. And I don't know that it necessarily matters as an industry fund. I think, again, it's this tied agency issue for me and tying clients in and locking clients in that becomes really problematic. But, of course, as a business, that's what you want to do because that makes great business sense. I think where advisors can help in this is making sure that, again, when they put clients into products that do lock them in, that they understand them, that the clients understand them, and that we think about the risk and that we think about the outcomes for our clients and make sure that there's a balance in their portfolios. And that doesn't necessarily mean that there's a problem with them. I just think there's a know your product issue here.
Thank you for allowing me to take you off course, Ryan, if you'd like to continue.
No, that's all right.
Danielle, you just mentioned then your work as a chair for another super fund. Your time at UBS and Equipsuper, how did that sort of influence or change your perspective when you became a regulator?
Yeah, I must admit my perspective changed quite substantially on the regulator. I used to be quite dismissive of the regulator in a sense, and I used to think they were just annoying. I now, having been 5 years there, I still think they're annoying. But now I think I have a much stronger appreciation of why they're there. And again, that real lowest common denominator issue, which I think is the bit that's so frustrating for everybody, because regulation worries about the lowest common denominator. Having said that, I think at the end of the day, if you structure a business that is, that is compliant, that's doing the right thing, it's actually really good for you longer term anyway. What I did, the other thing I learned was that legislation is a horrible process. And I must say, if I was ever to be in a position where I needed to influence government on legislation, I'd do it very differently to how I did it when I was at Equip. When I was at Equip, I thought it was really obvious, right, that you just go and tell them the way the world works and they'll believe you, right? It's not quite as easy as that. So I think there's a lot of nuances. How did it change my thinking around being a regulator? I think knowing how the pieces tessellate fundamentally changed my view. So really thinking about the interconnection between product, platform and advice, and where the harm in that value chain occurs, thinking about where the asymmetry of information exists. And they were the bits that worried me. So when there was, when there's asymmetry of information, when one person, i.e. generally the business, has more power than the consumer, then that's where you think about where harm can happen. And I used to try and think about that when I was setting the priorities for what we were doing. I'm not sure I got it right all the time. And in fact, I think a lot of people would say I didn't. But, I think, and I go back and think about fees for no service, which was in train before I started at the regulator. I'm not sure I would have been as concerned about that as my colleagues were, because I think that it was a little bit of harm across a lot of people, which ultimately came up to a really big piece of financial harm to the system. My concern was more, where is the harm at the consumer level, and where do you have catastrophic harm individually necessarily than a system, right? Which is more where you've got a crap advisor giving crap advice into an SMSF across, 20 or 30 people, where those people lose their life savings. And that's more around that individual banning of advisors. And I can't think of an advisor that we've banned or that ASIC have banned where people would look at it and go, oh, that's a bit harsh. Most of it, you'd look at the behaviour and go, well, that person really needs to be not in our industry anymore.
Yep, totally agreed. I think in my mind, I'm sort of flowing into how does that sort of tie in with post Royal Commission, how the industry, and you mentioned it, you alluded to it before, there were a lot of big players, and then that shrunk down to sort of some medium-sized licensees, splintering into smaller licensees. How do you think sort of ASIC has dealt with that? Yeah,
I think it's really hard. And it was, again, when I was at the regulator, it was one of the things we talked about a lot, was how do you get the oversight of this when it is fractured? And, at least when when there were only 3 or 4 big licensees, you could go and make sure that thematically the 3 or 4 big licensees were doing what they needed to do, and wasn't that hard. Whereas when there's 40, 50, 60, 70, 80, 90 of those, it's much harder to do. So I do think what will happen is that that ASIC will become more reliant on reports of misconduct, more reliant on AFCA, more reliant on that type of data coming through to be able to identify where the problems are, because it won't be obvious at a single licensee level, and it won't be obvious or as obvious from an on-site surveillance that there's a problem, because they won't be able to do the on-site surveillance of enough to make it to find the problems. I think AI will help. So all of the reg tech that's coming through, and, they are looking to use more of that They are looking to think about, how you use data scraping and things to find problems. But it becomes much harder.
We speak about this quite a lot when we have our compliance webinars around data sharing in terms of, and I think it ties in with the ethical question we had before about, if advisors are having complaints or there's incidents that arise, making sure that they're not just keeping that to themselves and they are letting us know so that we can forward that information on to where it needs to go, so that data is out there. But I think there's also a fear that when it's out there, then it, what's it going to mean if I put it out there? So we try to, sort of reassure people that it needs to be done, but it's good to have some data rather than no data.
Yeah, absolutely. And look, I can also, I'm happy to share that, when the new complaints regime came in, what we were more concerned about at ASIC was people that didn't have a complaint or didn't have a breach than those that were reporting regularly breaches that were, quickly fixed, identified and moved on. Not reporting, I find it almost impossible to believe that any financial business in the country isn't breaching some law at some point pretty much every day, right? Because at the end of the day, the legislation is so bloody hard to comply with. But there are going to be breaches all the time. So people who come to me and, it wasn't in the advice industry, but I had a number of super funds say, we've had no breaches ever. I'm like, really? I'd like you to go back and have another look, because there almost must be, you just don't know about it. And that concerns me more actually than those that are, again, identifying problems, fixing problems, moving forward. And I think I think that's the sort of general state of the world. And unfortunately, sometimes you will be the one that reports a big problem that is a big problem that actually is industry-wide, that ASIC goes, well, we're going to ping you for that because there's a deterrent effect. And that's sort of, I know people say it's unfair, and yeah, it probably is. I'm not sure regulation is fair. If you happen to be the first, then you've probably got a problem.
I'm just hoping you said breaching every day. I hope that the advisors on the webinar are going to send me a breach every day from now on. So thanks for that one.
I'm making sure you've got a job.
Like, thank you. No, I do appreciate that. Jonathan?
Just one more question from the crowd, following up on the specialised advisor or new class of advisor and the way it's been implemented. Has any consideration or discussion been given to following a similar path to the UK's version of the Royal Commission, where clear delineation between licensed financial advisor and restricted financial advisor classification, the latter which is restricted to providing only simple advice? Has there been any consideration given to that sort of thought pattern?
I'm not sure. Certainly when Michelle Levy was doing her review, there was quite a lot of discussion about this. I actually quite like what the UK have done. I think it makes good sense. I am not sure where Treasury and government are at on that. I suspect you would get probably a better hearing on that under the coalition government. I suspect would see more value in pursuing that type of outcome. But I actually think it's quite neat in a sense.
I was reading some of the articles about you last year, Danielle.
That's terrifying.
No, they were good. They were good. You raised some concerns last year about the super system and being largely an accumulation phase and then moving to, and you mentioned this before, a retirement income phase and the decumulation phase. There is some continued noise around that. Just thinking or wanting to know, do you think the Australian super funds are sort of ready for that big sort of shift?
I think the answer to that is no, not really. There has been some change. We have seen some improvement, and even the fund that I'm now chair of, we are still developing things. We are still thinking about this. We are a long way from where I would say we are good to go and don't need to ever have this discussion again. I think there is still a long way to go, and a long way to go in advice, a long way to go in simple products. Like a lot of the products in the retirement space are really complicated. And, I'm not sure I understand them. So I'm certainly wouldn't be putting a client into them if I didn't understand them. So I think we do need to have better product. We need to have a better simplified advice. I think earlier there was a conversation about how we serve the masses, which I don't think I actually finally answered. I think I answered half the question, but not second half. And the second half of that, I think we will need to think about digital. We will need to think about engaging differently. We will need to think about what does help look like as opposed to advice. What's guidance, what's advice, and I think there is more that we can do in that, even under the current legislation. I think super funds have still got a long way to go.
What about liquidity concerns with that big sort of shift? Any concerns in that space?
Yeah, I mean, at this stage, I don't think so. The funds are generally pretty liquid at the moment. I mean, most funds wouldn't own more than 25 to 30% of illiquid assets. And at the end of the day, we're not seeing people taking lump sums. We are seeing conversions into income type assets, increasingly so, actually. So those outflows will be staggered over decades. And I think the funds now better understand their liquidity profiles than they ever have before. And so I suspect at the moment, for me, the bigger risk is actually probably on cyber front, actually, and protecting as we move into becoming a payment platform. How do we make sure that we don't have a payment cyber risk as opposed to necessarily a liquidity risk in the payment side? Which is all very topical given what happened in the last couple of weeks.
Yes. I just want to say thank you so much for joining us. The last question I had was more, I think, of a pet passion of yours, pardon the pun, but I might just ask Jonathan if I'm sure he's listening. Do we have any other questions come through the chat, Jonathan?
There's one question about asking if there's been any news on term allocation pensions or term allocated pensions. We've got 12 minutes left. Is that something, Danielle, you think you might be able to?
I don't know, to be honest. I would need to come back to you on that one. I'm not sure where the government's up to on the term allocated pensions. I know there's been some, there's obviously been some legislation that's changed around providing these innovative, I think they're calling them innovative retirement income products, which is such a catchy term. And that's around what's deemed as income. So the government has set a deeming rate of 2.25 on the income from those retirement products, which I think is extraordinarily generous, actually, given that 2.5 is the middle of the Reserve Bank band. To deem income on those at 2.25 is pretty generous. And they're also, in that same legislation, allowing, I think if you take out a lifetime income, they are only assessing 60% of the amount that goes across. Don't quote me on the 60, but I'm pretty sure it's 60. So those things are legislative, but I'm not sure where they're at on the termed allocated pensions.
Thank you for that.
Well, again, thank you so much. And I mentioned your pet project, Loki's Lodge. Can you tell us a little bit about Loki's Lodge?
So, Jonathan, you told me I've still got 10 minutes. Wow, I can fill that in a heartbeat.
Go for it.
Go for it. So Loki's Lodge is my passion project. I about 8 years ago set up an animal rescue where we rescue, rehabilitate and rehome predominantly farmed animals. We're based up in, the sanctuary's based up in central Victoria, where I have about 200 souls up there that I'm currently looking after. And it's been, I think this year has probably been this year and last year has been the most animals surrendered that I've ever seen, just through cost of living and through drought. Obviously the Victorian countryside is crispy and people can't feed. So for some reason they think we as a charity can. So that's always interesting. I've got everything from chickens and ducks through to alpacas, donkeys, horses and cows. Sheep and goats. I used to say I cleaned up the bullshit during the week and did the same on the weekend. It was just a different kind of bullshit. Not sure I'm allowed to say that on here, but there you go. You might want to cut that out for the recording. But it's fascinating, and it's taught me a huge amount actually around how you deal with crisis, how you stay calm, because animals never kind of go to plan A. It's always B, C or D that you finish up executing. So yeah, so that's my thing. And if you're keen, you can follow us on Facebook and Instagram, and you can share in the madness.
Perfect. Well, as an owner of a mini schnauzer, thank you so much for that.
Right.
And I think thank you once again. Thank you so much for joining us. It really is a great sort of honour for us to have you here. Someone with such sort of prestige in the industry. So yeah, thank you so much.
My absolute pleasure. Thank you for the time.
You're welcome. You have a good day.
Thank you.